Welcome back to Morning Trade Live. Time to go inside out on Walmart ahead of the earnings that are due out tomorrow. Sundaram is with us, equity research analyst at CFRA. You have a buy rating, $117 price target on Walmart. Tell me what you're expecting for tomorrow.
Yeah, hey, Nicole. Yeah, so we're actually expecting a strong quarter. Walmart, when they released their Q4 results in February, they did guide for a pretty softer than expected Q1, but I think trends have improved as Q1 ended. I think when Walmart gave guidance in February in general was a soft month throughout retail, but we've seen from the retail sales data that March retail sales improved. Tomorrow we'll get April retail sales, and we think that will also reflect strong consumer spending, partly because a lot of consumers did, front load purchases ahead of tariffs. But I think a lot of focus right now is going to be on the guidance. Wall Street is really expecting Walmart to raise its guidance for the year. I don't know if they'll raise it this quarter, given how, we still have a long way to go for the year, but we do think that Walmart will beat its full year EPS outlook, especially given the news this week that tariffs with China have been reduced from the triple-digit percentages. So overall, we are constructive. Walmart is one of our top picks in retail right now, and we do see a lot of upside for the stock.
So do you agree with Bank of America when they say Walmart is well positioned to manage the tariffs due to suppliers' relations and also pricing mechanisms? They have this relationship with the suppliers. They are the behemoth. Are they in a good position to sort of navigate through the tough tariff time?
Yeah, no, we do think so. I think the best way to frame this first is that Walmart is predominantly a food retailer. 60% of Walmart's U.S. sales are in the grocery category, which face less tariff risks. So really, we got to, if tariffs are really focused on the 1/3 of its business that are general merchandise. And in that, they do source a lot from China, but over the last decade or so, not just Walmart, but really all retailers have moved and diversified their sourcing, moved away from China, gone to other places in Asia, gone to Mexico, for example, and so we do think that its supply chain is a bit more diversified, which gives it less risk to tariffs. But really, the news this week with the tariffs on China being lowered is a big relief for retailers like Walmart, who've probably been waiting for this news before they would replenish their inventory. And another thing that we've been seeing throughout the retail space is that a lot of retailers have been purchasing inventory in advance of tariffs, and so inventory levels are a bit elevated. But I think now going forward, I think what investors will focus on is that where do we see inventory going from here? I think too much inventory would also be a risk too, because you have to remember a few years ago, Walmart, Target, a lot of retailers got caught off guard with too much inventory. Then there was a lot of aggressive discounting going on and things like that. So we'll also keep an eye out this quarter on what Walmart's inventory levels are as of the April quarter.
Do you think that in retrospect, they were talking about, they forecast the first year-over-year profit decrease for Walmart, this was in February, in 3 years. And that narrative really spooked the market. In the meantime, they managed to navigate. We don't have bare shelves, as people were sort of, fear-mongering a little bit on the potential of what could happen. I'm not saying couldn't, but it's not happening at this moment. So, in retrospect, did they sort of spook the market too much in February? And, I know that they lowball so that this way they don't need to meet these high expectations. And will they lowball again?
Yeah, so really all retailers, I would say, lowballed their guidance when they released results in February. Like I said, February was a tough month because that was one of the worst months of retail sales was in February. And a lot of that had to do with really bad weather. And so that was one reason you saw a lot of companies guide lower for the full year. And then also there was just significant tariff risks and uncertainty back in February, and even in when Walmart had its investor day in April, actually on April 9th, which is the day that we actually rolled back some of the reciprocal tariffs on other countries. But I think now the outlook has has significantly improved compared to a few months ago. So I think, what investors are going to be eager to see is that will companies start to raise guidance again? Like I said, I think Walmart will beat its full year outlook. I just don't know if that they're going to raise their guidance this quarter. There's still a lot left in the year, and so
Okay.
and clearly this outlook is driven a lot by policy. And so I don't know if they'll raise it this quarter. Maybe they'll wait till next quarter. But we do think that Walmart could exceed its full year outlook.
All right, because most folks seem more positive on Walmart right now. And to your point, and I read this earlier, I actually mentioned it earlier, 60% is groceries. People say, oh, Walmart, but it's not just consumer spending on discretionary or essential items, but it's really groceries. So they have a nice big thing there that they can really sink their teeth into, literally and figuratively. So what about other names? Do you like Amazon? Do you like Costco? What other names are well positioned with buy ratings in your mind?
Yeah, so we've been writing on this a lot this year, but we think there's 3 retailers right now that are best positioned to gain market share in this environment. That's Walmart, that's Amazon, and that's Costco. These 3 companies we think are outperforming. We have buy ratings on all of them. Actually, on Amazon we have a strong buy rating. We have a buy rating on Walmart and a buy rating on Costco. Like I said, I think all these three retailers are best positioned to gain market share in this environment. The news this week with lower tariffs with China significantly improves the outlook for all these retailers, especially the bottom line outlook. We do see pretty significant upside for all 3 of these names this year.
Just quickly, are any of your models showing recession or something worse than where we are now?
Yeah, right now our base case is that we do avoid a recession. We do expect to see slower economic growth this year, but our base case is that we do avoid a recession. And certainly the news this week of lower tariffs with China improves that outlook.
Okay, great to see you, Arun. It's really always great to have you on the show. Really appreciate it. Arun Sundaram, CFRA. Thank you very much. All right, now let's trade it. Tom White is here, host of Fast Market, taking a look at Walmart, and you have a bullish example trade for us. Good morning, Tom.
Morning, Nicole. Yeah, the first one I'm going to look at, Arun's all bulled up here on Walmart going into this report. The stock has pulled back from those all-time highs we saw earlier this year, about $105 per share. So maybe giving you some opportunity here with the stock trading just over 96. So I went out to the June monthly cycle. So giving myself some duration, because remember, last earnings is when this stock fell. The company gave a little bleaker outlook than maybe the street wanted, but the bar was pretty high going into the report. So going out to the June 20th monthly cycle, we're going to buy a call vertical here because I want to offset some of the costs on this bullish position here. 37 days to expiration. We're going to buy the 95 strike call. That's slightly in the money by just over $1, and then sell the 105 strike call. So the idea here is over the next 5 weeks that the stock's going to go back towards those all-time highs. If you pay a debit of around $360 for that, any debit that you pay on it is going to be your risk on that trade. It can expand to $10 if the stock does go above 105. But this is trying to take advantage of an earnings play, but at the same time giving yourself more duration on this position. Implied volatility levels, Nicole, are actually low going into this report because the overall market snapback rally over the last 3 to 4 weeks, which has lowered the implied volatility not only on the overall market, but on individual names, especially when we typically see implied volatility levels rising into an event like earnings. In Walmart, the actual implied volatility levels are relatively low going into these earnings because maybe the bar is low and the market's been moving higher. But this is definitely a bullish call vertical, offsetting some of the costs. But you definitely need a move to the upside at about 2.5% to get above that break even of 98.60.
Right, understood. And then you also have, thank you for that, you said how Arun was all bullish, but there are folks who maybe want to take a different turn here. You have a more neutral example for a trade for Walmart.
Yeah, taking advantage of yield here, Nicole, with this example. Looking at a covered call or buy right type of strategy where if you want to own the shares, right, it's got nearly a 1% dividend yield. That's not explosive by any stretch of the imagination, but they keep adding to that on a year-over-year basis. So looked at this covered call. For every 100 shares of stock that you buy in Walmart, we're going to sell an out-of-the-money call to the upside. I went to the May 16th monthly cycle that expires in just 2 days. and sold the 99 strike call against it. So for every 100 shares of stock you buy, you're selling out of the money call to the upside. 99 strike call, paying a debit of roughly about 94.80 on this, maybe a little bit higher. The stock has kind of trickled up. But if you pay that debit of 94.80, that means you're buying the shares at a discount of about 1.5% to where it's currently trading above 96. You get to collect yield because you own the shares, and you've got that cushion to the upside before you get your stock taken away. Or as you get closer to expiration over the next couple of days, say the stock pops to 100, you can buy that short call back on the 99 strike, roll it out another week, another couple weeks, another month, collecting more credits. That creates more yield on this longer term type of position if you want to continue to hold a short call against your long stock. But a little bit more conservative on this one, but more capital intensive because you are buying the shares to take advantage of the dividend also.
All right, Tom White, great to see you. Thank you for that. We appreciate it.
Thanks.
We'll have a lot to follow when it comes to Walmart tomorrow.